Okay, and let's just go ahead and put this in full screen mode. Okay, good. Okay, and audit evidence. Oh, come on. Okay, and you can see that audit evidence. Really, are we really going to have one of these kind of things tonight? And then they always say, hang on while we report the problem to Microsoft, like Bill Gates is getting a message right now and he's jumping out of bed to fix the problem, you know. So let's see. Now it's going to make me scroll all the way. Screen mode. Try it this way. What page are we on? 30 what? 39?
39.
39.
39.
Yeah. Okay. Okay. Fucking thing. I didn't say it. Okay. Oh, and I got to record? No, we are recording. Bleep. Okay. Now, let's go ahead and let's take a look here at audit evidence. Okay. And it includes information in written or electronic form as well as observations. Okay. So electronic form is also considered evidence. In other words, it doesn't have to be hard copy, doesn't have to be on paper, right? Accounting records consist of records of initial entry, supporting records. So our general ledger is the accounting records, our journals are accounting records, but also the supporting records such as invoices and whatnot are also considered accounting records. Now, there's corroborating evidence, and corroborating evidence includes minutes of meetings, confirmation, industry analysis reports, etc. Okay, so we have the accounting records, and then we look for evidence that will corroborate that. Now, we have said that evidence exists in both written and electronic form, but we need to be careful that if we have a client that heavily leverages technology and electronic records, we need to be aware that that information may only be available for a short period of time. And I think I've mentioned a couple times in here when I was involved in the audit of the federal government's public debt, we were working closely with the Federal Reserve Bank system, and their system only holds data at that time for 7 days because of the volume of transactions. So when we were planning the audit, we had to plan around that so that we would have sufficient evidence to support our opinion, months after transactions had occurred. So that's always something to keep in mind in an electronic environment. Then you come over and the evidence is supposed to serve a reasonable basis for our opinion. So the auditor must rely on persuasive rather than conclusive evidence. That's why we give what? We give only reasonable assurance that the financial statements are fairly stated, right? Sufficiency refers to the quantity of evidence. I used to work for a guy, he's passed now, but when he retired, he gave me a bunch of stuff. And one of the things he gave me was this scale that he had in his office. It was literally a bathroom scale. And I'm like, what is this, Dave? And he says, well, that's so that you know that when you're on an audit, you always have to pass the weight test on your work papers. Do you have sufficient evidence? Now, of course, it's not really a weight test, but there has to be enough evidence to support the opinion. And we're going to be talking about sampling here tonight. And when you use sampling techniques, you can actually make some very specific decisions as to the quantity of evidence that you need to support your opinion. But of course, we always need to do what? We always need to use our judgment. about various factors such as materiality, et cetera. Now, when we look at the amount of evidence, the sufficiency of evidence, it is influenced by the risk of material misstatement. So that really does what? That is really talking about extent, isn't it? We talk about what? We talk about the extent, the nature, and the timing of our audit procedures. So when we get to the quality of audit evidence, now we're really talking about what? Now we're really talking about nature, for example, external evidence rather internal evidence. We're talking about timing. So remember, we talk about nature, extent, timing of our evidence, and we abbreviated that, remember, NET, okay, or not abbreviated it, but we gave it mnemonic NET. So when we're talking about quality of evidence, we're really focusing on nature and timing. And note that if evidence is of a higher quality, then we may not need as much evidence. So if you're using external evidence, you can now maybe not have to have nearly as large a sample size to support the opinion, okay? Now, when we look, the appropriateness of evidence, okay, must be reliable and relevant, okay? And it depends on what is being determined there and what other evidence is there to corroborate. And what? And I'm just going to keep reminding you of this, guys, the assertion being tested. Okay, and the assertion being tested. So we always want to try to line up our evidence with the assertion that's being tested. Okay, now we come over and we talk about the reliability of evidence. And what we're really talking about here, guys, is a hierarchy as to the reliability of evidence. And what I want you to do, because they kind of go on and on here, and then they finally give us a pass key on the next page. Okay, so I'm kind of pointing you to the next page, to the bottom of the next page. Okay, when you come down to the bottom of the next page, they give us a nice pass key. Just flashcard this. Okay, so all we're doing here is we're telling you the hierarchy for, and this is substantive evidence. Okay, this is substantive evidence. Okay, and this tells us the reliability of substantive evidence. They probably should have been more careful with that. And so the number one most persuasive evidence is auditor's direct personal knowledge. If you see something, you go and you physically observe something, that is the highest level of evidence. Next is external evidence, which is more persuasive than internal evidence. Oral evidence is the least persuasive. Now, the only thing I need you to add to this flashcard that I'm asking you to make, and now we can come back up, is when we look at external evidence. Okay, there are two calibers of external evidence. So there's sort of a 2A, 2B kind of thing. So what happens? The external evidence that is sent directly, I'm putting an A and a B here, so it's 2A, 2B. The external evidence that is sent directly to the auditor is more reliable than a document that was prepared externally, but the client held it first. So if we get a bank confirmation directly from the bank, that's more reliable than, say, a bank statement, again, prepared by the bank, that the client held first, maybe wrote all over and then handed back to us. That is going to be less reliable than direct external evidence. Okay, but go ahead and just make that flashcard, and then, or you can copy that right there. There may be a flashcard in the Becker material that does that already for you. But what I want to remind you is how that relates to the slide that we had before, where we showed you the hierarchy of evidence for internal control testing. And you can see a similar pattern here, right? Reperforming control is analogous to auditor's direct personal knowledge. Inquiry is analogous to what? Oral evidence. And so these two lists together constitute the hierarchy of evidence for our control testing versus our substantive testing, which is what we were looking at there in that pass key. Okay, Question? All right, good. Now we come over and we talk about the relevance of evidence. And again, now the book is doing a good job of reminding us here. The relevance of evidence relates to the assertion. For example, this is an excellent example. In fact, it's such an excellent example. I'm going to have you flashcard the specific example here, which is when we're dealing with confirmation of accounts receivable, that helps with the existence assertion, because what happens? You go to the client's subsidiary ledger, you pull a sample of their customers, and then you do what? You go from the accounting records to the supporting documentation, which is a person out there that agrees that they owe, I don't know, $25,000. So that person actually exists. It helps us with the existence assertion. It does not help us with valuation, because what? Hey, they can be sitting there saying, yeah, I owe you the money, but guess what? I can't pay you because I'm broke, right? And so we would, for the valuation assertion on receivable, we would do a set of procedures, probably recalculating what they have put into the allowance for uncollectible debt, and see if that matches to what they see if, you know, our calculations match what they have put in to the allowance. And if not, we're going to ask for an adjustment there, and that would get us more to the valuation assertion. So typically what we see is we're going to have one or more audit procedure per assertion, right? And it's rare that a audit procedure covers more than maybe one or two assertions at any point in time. Okay, just flashcard that specific example, because I think that you know, there's a lot of questions that try to confuse that, and it's easy to get confused on that because you're saying, well, if the confirmation says the amount, that's valuation. Now we're gonna have to do something on collectability, right? Okay, okay, good. Come over and let's take a look at the next page, and let's just come down and note that we will revise our assessment of the risk and material misstatement as the audit continues. So what happens if we have certain results that indicate that maybe we need to increase our risk and material misstatement? That's going to have us alter the nature, extent, and timing of our audit procedures. Okay. If there are material misstatements that are discovered through our substantive procedures, again, that could cause us to think that maybe there's some weaknesses in the controls that could alter our assessment of the risk of material misstatement as we assess the control risk. And that goes on, even though we talk about it in planning, that goes on throughout the engagement, and you may have to change your sample sizes and whatnot as you start to find misstatements, or you may, you know, finally conclude that controls do not have operating effectiveness if you see enough errors, and then, you know, pull your nature, extent, and timing of your procedures for a high risk of material misstatement, let's say, instead of maybe a moderate. Okay, okay, good. Come over and let's take a look at our first question for today. I can see that the computer is trying to age me quickly because it's not going to cooperate with me tonight. Okay, good. Okay, looks like all of us have had a chance to take a look at this one. So I'm going to go ahead and end the poll, assuming the machine will let me find my mouse. Okay, and let's go ahead and take a look at the results. Okay, I mean, we had a pretty good outcome here. 75% of us got it right, and a couple of us picked A. And I think that the reason some folks picked A is because maybe, you know, when you read the question, which of the following types of audit evidence is most persuasive, and you read pre-numbered client purchase order, well, in that case, they're talking about what? Not your client's client, they're talking about your client auditor. So that then is what? That is internal evidence that was provided by the client. That's why that one is wrong, okay? And so if you were sitting there and you were confused, maybe you say, well, look, are they talking about the client did a purchase order form? Or are they talking about the client's customer's purchase order form? But then you look and you think, well, why would the auditor receive such a document directly from the client's customer? And the answer is you wouldn't. I don't know why you get a purchase order form directly. So now you start looking, you're saying, well, wait a minute, there's another external evidence here, which is what? Which is the bank statement. These other things are all internal. No one picked that. The bank statement is external, even though it was held by the client first. So now you're like, okay, C has to be the correct answer, even if you're a little confused about A. But A, when they say client purchase order, they're talking about your client, meaning that that is an internal piece of evidence, not your client's client. Okay. Okay, good. Let's come over and let's take a look at, so C was, I don't know if I had indicated there with my pen, but C was the correct answer, right? Most of us got it right. Okay, good. Let's come over and let's take a look at the next module here. And, you know, this is, I don't know, some years back, CPA review started to feel like they needed to be cute, okay, in order to, you know, attract students. And I was always, well, isn't it all about passing the exam more than cute? You know, I mean, we can have a laugh now and again, but we don't have to go way out of our way to, you know, draw funny pictures and stuff like this. Okay. But anyway, what this is trying to do is give you a mnemonic, okay, for standard audit procedures. And I just find this annoying. Okay, because so what? So you have a mnemonic now that helps you remember a bunch of audit procedures, but if you don't know what to do with these audit procedures, it does you no good. I mean, what am I trying to accomplish by doing these 5 carat wars things? Okay, and the answer is you are trying to what? You are trying to get evidence that will support the assertion. And so the process is not a laundry list of procedures. And I really don't want to kind of lull you into thinking that all you have to do is memorize this and now you can pass the auditing exam, when the reality is okay, the reality is you need to be what? You need to be able to sit here and look at this sales chart item that I had put up for you before. You may need to look a little bit closely on the screen so you can see it. But we have an account, we have a related account, because sometimes some audit evidence supports one account will support another account, because in accounting we have a double entry accounting system. You debit something, you credit another account, so you may be able to get evidence for another account while you're maybe auditing, say, sales. You could be getting evidence for accounts receivable and vice versa. We think about the assertion. We use our imagination. What could be the potential misstatement in the assertion? And then we look for an internal control that is particularly well suited to prevent, detect, correct that particular misstatement in that assertion. If we think that that control is suitably designed, we do a walkthrough, we see if that control has been implemented, and if we like the design and it's been implemented, we can assess the risk of material misstatement at less than the maximum. Now, if we assess the risk of material misstatement at what? At maximum, then we'll go directly to what? We'll go directly to our substantive testing. And that's where we find a procedure like confirmation, which lines up well with the existence assertion. But the book, when they list off these 5 caret cards, they barely mention assertions. So that's what I don't like about it, because you're looking for something with the assertion. Now, if we find a control that we think has, good design and has been implemented, now we can test the operating effectiveness by testing the control and then going and altering the timing, extent, and nature of our substantive procedure with smaller sample sizes, et cetera, whatever. And that's sort of what's talked about in this last column. Notice as we're going through, we're assessing risk, we're responding to those assessments of risk. So to sit here and ask you to, have this silly little thing bouncing around in your head of 5 caret wars, whatever, I'm not doing that, okay? Now, having said that, and what bothers me about this list, they start listing off all these different things, vouching, inspecting, cutoff review. We'll talk about analytical procedures later. And then all of a sudden, just to make it spell 5 caret cars or whatever it is, wars, they throw in reperformance. Meanwhile, we're supposed to be talking about substantive procedures now. Reperformance is what? Is a internal control type of evidence gathering process. So, at some point, this thing starts to collapse under its own weight. A walkthrough is an internal control procedure. So they really, start to mix things up here, which gets very irritating to me. So I'm going to just go past that. Okay. And what I'm going to do is come over and talk about type of substantive procedures where they do give us some broad labels on substantive procedures that are useful for us. So let's just look at that. And when we look at our substantive procedures are designed to do what? To detect material misstatement. In other words, we put our procedures in place, our substantive procedures in place to do what? To lower our detection risk, right? So if our RM,
I have a question on one thing.
Yeah.
When we were going through the laundry list of types of procedures, I was a little bit confused between examination/inspection and observation, because I know there was a question that I got wrong, because I thought that if you have them open the box when you're doing inventory, that was part of observation, and it turned out that was actually examination. And so could you just speak a little bit about the difference between those two things?
I don't know. Some questions on the exam, are written by nerds. I would guess that the difference between observation and inspection, observation would be watching somebody do something, whereas inspecting would be actually looking at, say, some inventory to see if it was damaged.
Okay, so inspection is really just a closer look. It's not a closer look at the thing as opposed to the observation, which is generally looking at more at a process. Is that really the distinction?
I guess. I mean, I'm not comfortable sitting here giving you some sort of definitive answer on that, because I don't want to create this, impression that and maybe it's written in a textbook somewhere. I don't know, but I think with questions like that, learn from what you looked at there. Okay, and maybe it's worthwhile to have this conversation for that one question, but you're probably not going to get 100% on the exam. You're probably going to run into some stupid questions, and I don't want you to get too tangled up in that kind of stuff, as opposed to keeping a high level look at things. But yeah, I think observation, I guess, is probably more geared towards observing somebody doing something.
Okay.
Versus probably better for internal control. Okay.
Okay.
Whereas inspection is probably more, actually looking at a, non-human thing, like inventory or a voucher to see if it's got a credit approval stamped on it or something like that.
Okay. Thank you.
Mm-hmm. Okay. Okay, good. Now, when we look at our substantive procedures, remember, guys, we have to do what? We have to bring down our detection risk when our RMM is up. And the way we bring down our detection risk, what's up here? What will be the upside here?
Substantive test.
Good. Our substantive procedures. So substantive procedures, that's what they're saying. I don't think I can fit it in there. Substantive, I have to cut it into 2 lines there. Substantive procedure is really designed to do what? To detect the misstatement, to lower our detection risk. Okay. Okay, good. Now, when they talk about substantive procedures, they tell us that we can have test of details and we can have substantive analytics. Now, we don't have to have substantive analytics, but we can. Okay. So when you take a look at and let's say this is our substantive, this rectangle represents our substantive procedures. That's a substantive. Test of details probably are going to make up the vast majority, and it really depends on the account and the assertion. But the vast majority of our evidence will probably be substantive procedures, but they test of details, I should say. For example, confirm account receivable is a good example of a test of details, okay? But what we can also supplement that with some of these analytical procedures, which is not accounts payable, it's AP. I'm calling for analytical procedures here, okay? So just keep that in mind that you can have both of those. Now, when you do a test of details, let's take a look at that. And test of details now, as you look at that, can take 2 forms. We can do a test of details on ending balance, and we can do a test of details on transactions. And most auditors will tell you, hey, you're going to have a combination. Okay, so if an account has a high turnover rate with many transactions occurring during the year, the auditor generally will concentrate on testing year end balance. Okay, so go ahead and flashcard that. The alternative there would be that if we this approach is employed, test of details trends. This approach is employed when the account being sustained has relatively few transactions occurring during the year. Then you would go ahead, such as treasury stock and whatnot. Then you would go ahead and do what? Test the transactions. So you can go ahead and flashcard that. And you don't use one exclusively. You can have a combination of the different 2, and most entities would do that. Okay. Okay, good. Now you come over and let's talk a little bit more about these analytical procedures now that we were pointing to up here. Okay. Now, when we look at analytical procedures, and I think, yeah, let's just go to this table. I was going to flashcard some of that paragraph information. Yeah, well, highlight some of it. Let's take a look at some of that. Yeah. Analytical procedures are evaluation of financial information made by the study of plausible relationships among both financial and non-financial data. Okay. Now, a couple of important things. Plausible relationships. Okay. So you're looking for a cause and effect type relationship, and you don't have to limit your analytical procedures using purely financial data. You can also use non-financial data. Okay. Now, when do you use these analytical procedures? And now I want to go over to the chart on the next page, and I want you to flashcard this. Okay. And we are required to do a set of analytics during the planning phase. Remember, we said that those are at a high level, for example, comparing last year's balances to this year's balance, actual to budget, to give us a high level look of anything that's standing out at the beginning of the engagement is unusual. We are also required to do a set of analytics at the end of the engagement. After we've done all our audit work, maybe made adjustments and whatnot, do our accounts look correct when we consider these plausible relationships. So we are required to do a set of planning analytics, a set of final review analytics, substantive analytics, that little, whatever color I painted it, green part of that box is not required, but the standards understand that there may be times where you'll want to employ an analytical procedure to give you substantive evidence. Okay, so that's where we start getting in down here into the outline, where they start talking about that process where the auditor has chosen to perform substantive analytics. So let's just stop for a minute and use an example. Let's say I'm auditing a laundromat, and I'm trying to get a good feel for the washing machine revenue. They're reporting revenue, and I want to get a feel for how much revenue was generated by washing machine sales, right? Now, it's probably going to be hard to do a test of details because there's no invoices or receipts. People come in and drop coins into a machine or whatever, right? Okay, so can you think of an analytical procedure, maybe using non-financial data, that we might be able to generate to help us to figure out the washing machine revenue? That's a question.
Maybe look at the utility bills.
Okay, utility bills like water, maybe?
Yeah.
Can you wash clothes without water?
Nope.
Not that I know of. Okay, maybe you could beat them on a rock somewhere. Okay, but these days we go ahead and we do what? We go ahead and we use water to wash clothes, right? So let's say we're auditing a laundromat, and we say, well, can you please show us the washing machine revenue? Okay, and they tell us that the washing machine revenue, and let's say they tell us it's $15,000. Okay, we say, okay, let's see if we can get a handle on that. So we sit there and they charge $3 per load of laundry. Okay, and let's say we don't know what the washing machine revenue number is. I think I'm messing this example up. They charge $3 per load of laundry. And let's say that we look at the water bill, and let's say that they used 10,000 gallons of water. Okay. And let's say each load of laundry uses 2 gallons. I don't know how many gallons you need to do a load of laundry, but each load of laundry uses 2 gallons. So we take the 10,000 gallons, divide it by what? By 2. And that means that they must have done what? 5,000 loads. Okay. And they charge $3 per. So we take those 5,000 loads times the $3, and we're projecting that the washing machine revenue should be about what? About 15,000, right? And we set that up as an expectation for our substantive analytic. And we're doing this, of course, because we don't really have the option of doing a test of details, presumably in this example, right? Now, what the auditor will do is they'll put a range. In the GAO, we used to say, our financial audit manual said that for analytics, you should be plus or minus 20% in order to be satisfied that that analytic gave you, sufficient evidence. So to support the assertion that you're looking at. So plus 20%, if I'm doing my math right, is what? We'll go as high as 18,000. We'll go as low as 12,000. Am I doing my math right on that? Plus or minus 20%. Okay. So what happens? Now, if the washing machine revenue comes in at, say, they reported, say, 17,000, the auditor is what? That's the happy auditor, because the auditor is saying, okay, yeah, I was willing to go up to 18, and at 17, we're good, right? We don't expect them to come right in at 18. Now, if they, at 15, excuse me. Now, if they report 23,000, is the auditor happy, sad? The auditor is inquisitive. That's an open mouth asking questions. You don't automatically go and kill them just because they're outside the range. You say, gee, we did this, and then we took the city water bill, we got the gallons. You use the city water bill? Wait a minute. Don't you know that some of our customers only want their laundry washed with rarefied water from the mountains? So we have to have that trucked in. And we charge $5 per load for that. And you say, oh, okay. And you put that into the analysis, and that explains the difference. The auditor's happy, right? So now, if you really think about it, we're turning to a tested detail. So we might ask to see some of the water trucking bills to see how many gallons were delivered and whatnot. And so we take a different approach if our analytic doesn't turn out the way we want it to. Okay. All right, so I use that little example just so that when we're going through the things that we're going to flashcard now, we're going to flashcard some of the key elements of the process. We can reference back to that example. So determine that the analytical procedures are suitable for testing the assertion. I'm, in this case, saying that's probably the best shot we've got at getting audit evidence on something like washing machine revenue. Flashcard, what I'm highlighting here, guys. Evaluate the reliability of the data from which the auditor expectation is to be developed, okay? So I think we'd be pretty good here because we're using what? External evidence generated by a government entity, the city, for our evaluation. Even though it was external evidence that was first held by the client, it's still external evidence, so I think it's pretty reliable. Going back to the audit of the public debt that I did with the Federal Reserve, we were going to use some of their data for some of their operating data for an analytical procedure. And I started asking about controls over the generation of some of this data that we were going to use, operating data. And they got all upset with me. You're now going beyond the scope of the audit, and started giving me a hard time. And I'm like, no, guys, I can't use data in an analysis unless I know that that data is reliable. So well, if you're going to insist on looking at that data, we're going to have a security guard come and sit here with you while you go through it. And I'm like, hey, go ahead. I'm from Hayward. That's not the first time I've had interaction with law enforcement. I mean, whatever. I don't care what you got to do, but I need to see something. So they backed off of their threat at that point and went ahead and got us the data that we need. So the point of that story is you do need to evaluate controls over data, the reliability of data that you're going to use in an analytic, okay, even if it's non-financial data, okay? Then you develop an expectation. Hey, we think that the washing machine revenue should be about 15,000. And you could use, say, information from prior periods, relationships of financial data with non-financial data. Isn't that what we did? We used the water bill, okay, the gallons of water. Okay, now, guys, I want you to keep flashcarding here the things that I'm highlighting, because these are key steps, okay? So that flashcard can continue here now with number 4. Perform the analytic procedure and compare with the results. Okay, 15,000 is our projection. They're at 17,000. We're done. 15,000 was our expectation. They were at whatever I said up there, 23,000, whatever our second example was. So what do? We sit here and we inquire of management. So they said to us, well, you got to get the trucking bill in there. And then we do what? We perform other audit procedures as necessary. Now we start getting what? Now we start getting some of the trucking bills and that kind of stuff. Okay. All right, good. So flashcard those steps. Okay. And when we are looking at using an analytical procedure for our substantive, it really has to go with the assertion. Okay. So what happens? It tell us analytical procedure are most effective and efficient for assertions in which potential misstatements are not apparent. So what are they telling you there, guys? Well, if finding a potential misstatement is not apparent, they're telling you that RMM is what? Is low. That's what risk of material misstatement. If it's low, then misstatements, potential misstatement is not apparent, right? And so what they're telling us is that what? Our detection risk can be down, meaning, can be up, meaning that what's down? Our substantive procedures. So they're admitting here, okay, that what? The analytical procedures are not as effective as the test of details. But if you have a low risk of material misstatement, okay, go ahead. Maybe turn a little bit more towards analytic, or when evidence from a test of detail is unavailable, back to our washing machine example. Okay, so go washing machine revenue example. So just go ahead and flashcard that point, and then come over, and in order to provide a level of assurance, analytical procedures should be based on predictable relationships. Water bill to washing machine revenue. You can't wash clothes without water. That's a predictable relationship, okay? More predictable relationships are provided in a stable rather than dynamic environment, okay? For example, transactions happen fairly evenly over the year, let's say. And I'm not sure I'm in love with the way they worded this. Involve income statement and balance sheet accounts is probably the way they should have written that. Okay, they make it sound like the income statement accounts are something special. When you have transactions involve both income statement and balance sheet, you have a base that you can leverage your analytical procedure off of. For example, I'm just going to put in here, e.g., debt on balance sheet to what on income statement, do you think? You have debt on the balance, huh?
Interest expense?
Yeah, interest expense, excellent. So if you're sitting there, there should be a plausible relationship that if I get comfortable with the amount of debt and I can come up with some average interest rate for the debt of the entity, that should tie nicely to the interest expense, okay? That's what they're trying to say there. So you can flashcard that. And also, if there is less discretion of management in determining the amounts, in other words, there's not a lot of management estimate in there, then the analytical procedures are going to work a little better for you. Okay, so flashcard that, because those are key words, because I think a lot of times we start thinking, okay, well, analytical procedure, there's a set of them that we're supposed to do. It's more of an art than a science, in that you got to kind of see how things can line up to help you to see these plausible relationships. Okay, and again, the reliability of data is enhanced if it comes from what? External sources rather than internal. And again, if it is internal, then you're going to have to look under controls over the data that you're using in the analytic. We use the external water bill in our example. Okay. Now they come over and they talk about methods that are used to develop the auditor's expectations. And why don't you go ahead and just flashcard at a high level, not this whole table: trend analysis, ratio analysis, non-statistical predictive modeling, regression analysis. And we're going to talk more in module 10 about data analytics, and we'll talk a little bit more about using some of these types of tools there. But this is a good opportunity for us to flashcard at a high level, you know, some of the different methods that you might use in developing the auditor expectation. You know, they talk about regression analysis here. I mean, we could do what? We could literally do a regression analysis maybe over time of gallons of water that have been used to what? To washing machine revenue. And we'd be hoping to see what? Some kind of relationship, you know, that as they use more water, right, the washing machine revenue goes up. Now, you know, what regression analysis will do is it will fit a line Okay, it'll just go ahead and fit a line to those observation points, and it'll tell you if they're behaving in a correlated manner. Okay, so if we get a correlation, coefficient correlation at around 1, that's telling you, hey, yeah, you've got a nice match there. If you're sitting there and the thing is negative, which would be odd, they're saying you've picked the wrong things for your analysis. You know, if it's a 0, they're saying these are not moving in any kind of, you know, predictable pattern. So this is probably not the best thing for your analytic. Okay, and that's the kind of thing that regression analysis will allow us to do that is much more scientific. And we'll talk a little bit about regression analysis later. The details of regression analysis, though, really get into the BEC section. So some of you that are taking BEC as well, we've already talked about that, I think, in the BEC class. Okay, good. Let's go ahead and let's flashcard documentation requirements, guys. And I always ask you to flashcard the documentation so you know it has to be documented. And it's always a nice summary of what we are required to do. So what was our expectation? Hey, there should be a relationship between the water bill and the washing machine revenue. We thought it should be about 15,000. We considered the water bill. We considered the amount per load. The results, we then had to ask for unexplained differences and what were the additional procedures. We looked at some trucking bills, that kind of stuff, and we were satisfied. Or we weren't satisfied and we're not satisfied and we're going to disclaim an opinion on washing machine revenue, whatever it is, however you came out with that. Okay, good. Now you come over and as we've said, analytical procedures, and I asked you to flashcard that table, are required in the overall review stage of the audit. And the purpose of doing this at the end of the engagement is to evaluate the overall financial statement presentation, to assess conclusions reached, and to assist in, of course, forming the opinion on whether the financial statements are materially misstated. So you can flashcard that. You know, the problem is that while you're auditing the financial statements, often they're making changes to the financial statements. So, you know, it's sort of this moving target. And so final set of analytics, when you're letting everything cool and dry, it's probably is a required step so that if anything weird happened, it is the wrap up, as the audit gets to the wrap up, is helpful. Okay, now I don't like this graph at all for 2 reasons. One, they're using this word vouch and trace, and vouch is used for existence and trace is used for completeness. And what I don't like about this is they're lulling you into a sense that all you have to do, they even draw a little picture with a V and a T there. And I got drunk one night and looked at this and it still didn't make any sense to me. Okay, so, you know, they're using this little V and T and it's supposed to make sense to me somehow. And I'm like, this is, you know, malpractice to make my students think that all they have to do is memorize vouch for existence and trace for completeness. That's going to be a problem on the exam because the exam is under no obligation to use those words when they're talking about existence versus completeness. Okay, so don't memorize a word. I mean, understand that often vouch and is used for existence and often trace is used for completeness, but don't think it has to be that way all the time. So what I want to do is I'm going to go ahead and kind of mark this up a little bit. And so if you start at the financial statement, say you pull something from, say, the subsidiary ledger, but you start on this side of this little house, I guess, and then you start at the financial statements. We'll just do it that way. You start here, and then you go to supporting documentation. What assertion is that? Don't look at that picture, because that's what I'm saying. I look at the picture and I don't know what the hell is going on. Okay, so don't look at their picture, look at the way I drew it. If you start from the financial statements and you go to supporting documentations, what assertion?
Existence.
Good, excellent. That is existence, because I'm saying, hey, look, you say that you have a piece of equipment and it's listed in your subsidiary ledger, equipment number 573 in warehouse number 111, or factory building number 1 to 11. So I go to factory building 111. I go from the subsidiary ledger, and my evidence is actually going and looking at that thing, right? For its existence. You say you have a customer that owes you $50. What do? I send out a confirmation to that person to see if they're really there, right? Okay. Now, if I start over here, okay, I start at the supporting documents and I bring it back to the financial statements. What assertion is that?
Completeness.
Now we're getting completeness. Good, because now we're sitting here and we're saying, well, look, completeness. Now we're sitting here and we're saying, okay, look, I have a cash disbursement. And that cash disbursement was made in January of 2022. I want to see, was that listed as what? As an account payable at the end of 2021, right? So I'm starting with the disbursement. I'm trying to take it back to the previous year's financial statements now and see if it was actually recorded as a liability, okay? So the auditor's favorite assertions are existence and completeness. So you've got to understand how to test those two. And we're going to practice with some of those a little bit later. Question. Okay. Okay, good. Now you come over. By the way, which assertion do you think is harder to audit of these two? Completeness or existence?
Completeness.
Completeness is harder to audit, right? Because what happens? I got the whole world out there that maybe should be included in the financial statements, and I'm trying to get it to fit to what should be in this little tiny document, the financial statements. With existence, I've got the financial statements. Now I just got to go out from this little thing and find the things that support the existence. So completeness is the more difficult to audit assertion. That's why when we finally talk about the management representation letter, we're going to put a phrase in there that says, you've given us complete data, right? Because we're worried about the completeness assertion. Okay. Okay, good. Now you come over, and this is all a lot of much ado about nothing, but let's just come over and let's take a look at external confirmation. Okay. An external confirmation is a form of audit evidence obtained to a direct response to the auditor from a third party, okay? And it can be either in paper or electronic form. An oral response does not meet the definition of external confirmation. You've got to have either an email or a written document back from the client. And so confirmations usually involve representations about account balances, okay? And it's really used quite a bit for accounts receivable. I mean, that is the classic step for our accounts receivable testing. Now, positive confirmation is requested the confirming party respond directly to the auditor by requesting information or stating that the party agrees or disagrees with the information in the request. So what you'll put in there is, do you owe $25,000? And you'll have a box down there. It's like this letter I sent to, you know, a girl I liked in my second grade class. Do you like me? Yes, no. We want them to do what? We want them to check yes. It's that simple. Okay. Now, what happens? If they check no, then we're going to have to do some additional work. But we are going to sit there. We want a response. Okay, and we're hoping for a yes. Okay, now you come over and negative confirmation, we say what? We say, hey, only reply to us if you disagree. If you disagree, then we want to hear from you. Okay, and we'll talk more about this process when we get into accounts receivable, but go ahead and flashcard at this point in time the definition between positive and negative. Okay, now which of these do you think is more reliable, positive or negative? Which is more reliable, positive or negative, do you think?
Positive.
Positive is more reliable, isn't it?
Yep.
So when would you use negative?
AR.
Well, wait a minute. I would use negative. I could use positive for AR. Why would you say accounts receivable? Huh?
What about accounts payable?
Oh, because you're worried about the existence. You're not as worried about the existent assertion is what you're saying there. Okay. Okay. Say it again.
Accounts payable?
Now I forgot what the question was that I asked. What did I ask?
When would you use negative?
Okay, no, for accounts payable, I am not going to use negative. If I confirm accounts payable, I'm not using negative, because negative, if you use confirmation for accounts payable, okay, you're going to send a letter to somebody saying, do I owe you some amount of money? Okay, and you want to use positive for that. In fact, you want to use blank positive. You don't even put the amount in. You ask, how much do I owe you?
Got it.
And so now what happens, if we're talking about accounts payable confirmation, you're saying, how much do I owe you? And you don't just put a yes, no. You make them fill out. Now I'm thinking I should have asked the person in the second grade, I should have asked her, how much do you like me? Because maybe I could have gone from there. So you're telling me there's a chance. Okay. So what happens is I'm sitting there and I make them fill that out. So what happens is my client's vendor goes and does a completeness test for me. If somebody sends you a letter like that, they're going to look through every transaction they've ever had and see that you paid them, right? So they go into their records and do a nice test that helps me with the completeness assertion, which is what I'm more concerned about for accounts payable, okay? Where I'm going with this, guys, positive confirmation, and again, we got to get away from thinking about accounts, the type of accounts, the assertion, right? With positive confirmation, if I'm saying it's more reliable, that must mean that what? That RMM must be up, okay? And so I'm trying to do what? I'm trying to lower my detection risk, and positive confirmation is a substantive procedure that lowers my detection risk because it's more reliable, isn't it? Okay. If I have what? Good controls, my RMM and whatnot is what? Is now down. Now my detection risk can be up. Yeah, now maybe I will go ahead and use negative confirmation. For example, if you're doing an audit of PG&E, you're not going to want positive confirmation from 30 million customers. Are you kidding? You'll be the rest of your life. So what are you going to do? You're going to sit there and probably use negative confirmation. Say, hey, only respond to me if you believe that you don't agree with this balance. Now, you don't have to just use one. You could use a combination. For account balances this much and lower, negative. For big account balances with larger amounts, we'll use positive. Okay, so.
Question on negative confirmations. How do you tell the difference between a non-response because they just blew you off and threw it in the trash and a non-response because they agree with you?
You don't. That's why it's less reliable.
Oh, okay.
But if you have a lower risk of material misstatement, then your detection risk can be higher and you can go to a negative confirmation. Okay. Okay, good. Now, external confirmation process, okay? And let's just look at some of the key elements here. And the auditor should maintain control over the request. And every time, I think I've told you guys, sometimes I have post-traumatic syndrome, stress disorder, whatever they call that. I'll be thinking back to engagements that I had back when I was with the GAO. And to this day, I still get mad at certain things. And I think about this, I asked a newer staff to tell them that we wanted to do some confirmation of some things, tell the client that we were going to do some confirmation of some things. And the guy told the staff, oh, don't worry, they can just send the confirmation back to me and I'll handle that. And so the staff said, oh, you know, and I looked and I said, well, what are we doing here? Why are they sending, what are we doing? Why would they send the confirmation back? Oh, well, the guy told me, and I know that guy knew better, and he was trying to run one past the person. I told him, tell that guy to go. I told him, go back and tell him we need to change that. What is he talking about? So it has to do what? It has to come back directly to the auditor, even though it may be on the client's letterhead and whatnot, and the company may think that they're responding, the client's customer may think that they're responding to the client, they're responding directly to the auditor. Okay. Now, if you come over and you take a look, if management refuses, and I don't like the way they use the word refuse there, because now it sounds like management is up to something. But if management comes to you and says, hey, look, you know, we'd really not sit here and confirm the accounts receivable, because every time you do, we have to talk our customers off the ledge for a while because they think that we're in trouble or something. Is there anything else you can do other than the confirmation? And we look at that and we listen and it seems reasonable and we can find an alternative procedure. For example, if we're confirming accounts receivable, what we could do is look to see if they collected on some major receivables early in that next year. And if they did, then we have evidence to support the existence assertion and we may not have to confirm. Okay, so there is always an opportunity to do an alternative procedure, and that's okay. Okay, now we come over and we take a look, and all confirmation carries some risk. And there was a story out there some time ago where I guess the auditor sent out confirmation and whoever was doing the confirmation was in with the client and basically, you know, fraudulently went ahead and responded to confirmation. I heard that on the radio. I was driving. I almost crashed my car. I'm like, what? You can't rely on confirmations? Well, it could be. So you always have to consider that. Okay. An electronic form of confirmation is fine. And you may have to get some sort of, you know, what you could do these days is pretty easy to do some sort of secure upload where they have to log into a system and it has to be secure upload of the information and whatnot. Okay. Now, if there are non-responses, the auditor would need to perform alternative procedures. So if the client's customer just doesn't get back to you when you're expecting them to with positive confirmation, do an alternative procedure, look to see that there was some sort of, you know, subsequent collection on those, but you just can't let them hang there. Okay. Oral response, which we've already said, is not good enough. Okay, has to be either electronic or some sort of written, you know, hard copy response, but you cannot, you know, just ignore non-responses. Okay, and then finally, if you have exceptions, all exceptions should be investigated to determine whether there are indicative of material misstatement, fraud, etc. Okay, and exceptions resulting from timing measurement differences are not considered a problem. So, you know, they're thinking that you meant as of a certain date and they look in their system and it doesn't match because of a timing difference. That's okay. They say clerical errors, and that's a little annoying. Clerical errors by who? By client's customer, not by the client. Okay, if the client made a clerical error, that's a problem. So we mean by client's customer, not by the client. Okay. All right. Good. Yeah. Let's stop there and take our break, and we're going to come back and start to review assertions. Actually, you know what? Let's do it and then take the break. I think that's better. So what happens? We have 3 categories of assertions. Account balances, that's what? That's all years transactions. We talked about this in an earlier class. That's all years. That says transactions. That's one word, transactions. That's all years transactions. So we're talking here that we're probably doing our testing from what? From the GL. Okay. Then we have what? Then we have transactions. That's what? That's pretty much the current year. So we're probably doing our testing from the journals, the current year. Okay. And then we have presentation and disclosure, and presentation disclosure assertions. Okay, they put together. Disclosure is what? Is basically footnotes. Okay, so what I want you to do, guys, is simply flashcard the assertions as they fall into the 2 broad categories that they gave us. Flashcard that, okay, and that should be good for you to be able to remember the assertions as they relate to the categories. Okay, again, it's important that you know how to audit the assertions. So you always got to get back to this little sales chart that I keep throwing in your face here. How do I sit there and line up the assertion, line up the control, and then line up the further audit procedures, either test of controls, well, how do I say, either always substantive testing, and then you may do test of controls depending on your assessment of the risk material misstatement, which we've talked about quite a bit. Okay. Now, when you come back to the book here, notice that they finally sit here and they do a good job here of lining up assertions with audit procedures. So they finally caught up with this. Okay. So you can flashcard this, but remember that we have to consider the intervening controls. Okay, so even though they're going directly to sort of a substantive procedure discussion here, we would still want to look for controls that would prevent or detect the potential misstatement of the assertion, like the sales chart that I just showed you. But notice, for example, for existence, they tell us, and confirmation is the classic way to test the existence assertion. But notice they're telling us that we will do what? And again, they annoy us with just using that word vouching there, as though God came down and said, anytime you talk about existence, it's vouching. And meanwhile, the exam doesn't hold to that rule. And so we go what? We go from the financial statements back to the supporting docs for our existence occurrence for completeness. Okay, we're going to start from the source document and go back to the recognition and the accounting records. Okay, and the financial statements. Isn't that what we talked about? Okay, cutoff, we look at transactions before and after year end. Okay, and so we're sitting there and we're looking at transactions near the end of the year to see if they were properly recorded. So we might look at some shipping documents close to the end of the year. Okay, they shipped those out at December 31st, but now we've got to look a little closer and say, yeah, but what were the shipping terms? If it was free on board destination and those hadn't arrived yet, then it's not a sale, right? Okay, that would be a good example of a cutoff test to see that something's included in the correct year. When we look at valuation, allocation, and accuracy, guys, these are estimates. And when you audit accounting estimates, you recalculate. You recalculate. You sit there and you say, well, depreciation is an allocation, isn't it? Do they really know if this asset's going to last 20 years? They don't. So you would look and you would recalculate to see if they put the correct amount in for their depreciation, etc. Okay. All right. So that gives you a sense of some audit procedures that line up with assertions. That's why I wasn't too interested in that 5 caret cars nonsense or whatever it was, 5 caret wars, because you got to get good at lining up the assertions with the audit procedure. Okay. So with all that, I know we're going a little long past the break time, but let's just go ahead right now and answer these 3 multiple choice questions, and then we'll take the break. Okay, guys, I'm going to go ahead and end the poll. So make your best choice here. And let's just go ahead and take a look. And okay, most of us got this correct. 75% of us did. A few of us thought that B was okay. But remember, guys, when we are doing our substantive procedure, what are we trying to lower? What are we trying to lower when we do our substantive procedure?
Material misstatement or detection risk?
Good. We're trying to lower detection risk, right? So we're trying to detect material misstatement by doing a substantive procedure, right? If you're waiting for deeper meaning, stop. Okay, so we're doing the substantive procedure to lower the detection risk to detect the material misstatements, right? Okay, okay, good. All right, let's go ahead and let's look at the next one. And why is the poll still up there? I thought I stopped sharing it, but I guess not. Okay, all right, it's all right. I need to relaunch it anyway, so. Okay, guys, let's go ahead and take a look at this. Looks like most of us have had a chance to look at least the group that's participating tonight. Okay, and so when you take a look, most of us got it correct. The answer is B. I think it might be in part because I kind of tipped you off on that a little bit during the discussion, during the lecture, but let's just go ahead and look at these and see, well, you know, could you come up with an analytical procedure for these, and which one has the best chance of being used for an analytical procedure? So accounts receivable, we're going to be worrying about the existence assertion. Can we really come up with an analytical procedure? What? And sometimes students will say, well, why don't we look at sales in accounts receivable? What if it's a cash sale? So you look for what? You look for the account that has the least possible amount of noise around it. Accounts receivable is a problem because you're sitting there and you're like, well, okay, but maybe I could look at sales and do an analytic there, but I've got cash sales. You look at accounts payable and you say, well, okay, why don't I just look at the inventory account, see if there's a connection there? Yeah, but what happens if you have accounts payable for expenses? So that's got some noise around it. Travel and entertainment expense, I'm not even sure how you could come up with analytic for that, you know. So then you start to look, okay, interest expense, which is the correct answer. Yeah, I get comfortable with the long-term debt. The natural flow, the thing with the least amount of noise here is what? Is the interest expense. These others have other things around them that might interfere in a nice clean analytic. Okay, so you look for the cleanest relationship you can there in that question. Interest expense and debt would be the one. Okay, good. Let's take a look at this question. Come on, mouse. It's not the mouse, it's the cursor that likes to disappear on me. I'm trying to put the poll up, guys. I'm trying. Let me try it this way. Maybe if I exit out. And yeah, that seems to help a little bit. Now remember, it says in determining whether transactions have been recorded. What assertion? In determining whether transaction,
Existence.
In determining whether transaction has been recorded.
Completeness.
Completeness.
That's completeness. If it hasn't been recorded, then the records aren't complete, right? Okay, no, that's okay. But you got to get good at that. They did not call out the assertion, but that's what they were testing you on here, right? They were testing, do you know how to audit the completeness assertion? And if that's the case, we're going to start from what? The source document. Right? I mean, the only thing they left out, if they said in determining if all transactions have been recorded, if they wanted to help you, you know, they would have put the word all in there. Unfortunately, the examiners are not necessarily always there to try to help you, right? Okay, so they made it intentionally vague there that they were talking about the completeness assertion. But once you crack that, this is an easy answer, right? And it looks like about 90% of us, I don't know if those votes came in after I told you the answer, but most of us got this right. Okay, question? Got to get good at questions like that, and we're going to continue that mantra throughout the class. Now, again, I'm going a little bit past our normal break time, but what I want to say right now is I am not going to go through Module 7 with you. I am not interested in sitting here and just running you through a bunch of ratios, you know, and saying, well, divide this by this, divide this and multiply it by that. What they do here, though, is they give you a listing of ratios, and you should have a flashcard for every single ratio they give you in here. And then they give you some batting practice by showing you the financial statements and showing you how to calculate those. Your Becker flashcards have these ratios for you already, but again, very important. You have to know every single ratio that's in here, because they're going to ask you to do a task-based simulation in which they'll ask you to look and calculate some ratios and also interpret what they mean. And so you've got to be very, very comfortable with these ratios. So I want you to look at this stuff on your own, get comfortable with these ratios, and make sure you're practicing with the practice task-based simulation for this chapter that has you looking at these ratios. Okay? Okay, good. So what I want to do is take the break right now, and we will come back and pick up module 8 on sampling here. Part 1 anyway. Module 8 and 9 are parts 1 and 2 of the sampling, and we'll get through that. I'm going to pause the recording. Somebody remind me to turn it back when we come back. Okay, so we're resuming the recording now, and just ask you to make a couple flashcards here regarding statistical versus non-statistical sampling, either acceptable under generally accepted auditing standards, and the beauty of statistical sampling, the advantage is it allows us to quantify our results. Okay, so that's why you would want to use it, but you do not have to. Okay, now random sampling, okay, should be used. Okay, so just go ahead and flashcard that. We should use some sort of random sample selections. Okay, we're going to give you an example here of some of these things in a couple minutes. Types of sampling, okay, we have 2 types. We have attribute sampling, which is used for testing internal controls. Okay, so when you're looking at attribute, you're looking at something and you're saying, does it have a certain attribute? For example, is the time card, does it have the attribute of having been signed by the supervisor? Okay, variable sampling and PPS sampling are used for our substantive procedures. Okay, so flashcard when we'll use these different types of sampling, and we're going to talk about and have examples of all 3 types: attribute, variables, and PPS sampling. Variables and PPS are for substantive tests. Attribute sampling are used for our internal control testing. Okay, now you come over and we talk about uncertainties, and we talk about uncertainties as they relate to audit sampling. Okay, and we have our audit risk. Okay, we have uncertainties due to sampling and uncertainties due to factors other than sampling. But we know that audit risk is what? Is our IR times our CR times our DR. And where we tend to use sampling techniques is on what? Is on our control testing and our substantive testing. In other words, what? Our audit risk will never be 0, okay? And because there's always a chance that what? The sample is not representative of the population, we could have what? We could have sampling driving up our what? Our detection risk, right? Okay, so sampling does factor into audit risk in this way, okay? Now there are factors other than sampling issues, and I'm just going to ask you to put C, page 75, item, what is it, 2.3. Okay, we'll get to that in a little while, but that's where they kind of call out those things. Okay, but that's what we're talking about. How does sampling risk affect our audit risk? It affects it by affecting my what? My control risk and my detection risk. So let's just go ahead and take a look then. If it's affecting my detection risk, that's because I'm using sampling for my substantive test, right? We lower our detection risk through our substantive tests. So if we use sampling and there's some risk that the sample will not be representative of the population, then that's bringing up my detection risk. Now, when we look at our sampling as it relates to our substantive test, we have 2 categories. We have the risk of incorrect acceptance or the risk of incorrect rejection. Okay, risk of incorrect acceptance is that the auditor does what? The auditor concludes that the financial statements are not materially misstated, when in fact there is a material misstatement. In other words, we gave an unmodified, unqualified opinion when we should have qualified or adverse or maybe disclaimed our opinion, right? That's audit failure. Okay, risk of incorrect acceptance. Risk of incorrect rejection is the risk that the auditor will sit there and do what? The auditor will say, hey, there's a material misstatement in the financial statements, and maybe start asking for adjustments and whatnot based on the sample, when if the auditor had just looked at all of the transactions, they would have found that there was what? Not a material misstatement. So you've got risk of incorrect acceptance, risk of incorrect rejection relates to our substantive testing, okay? Now, are these mistakes that were made by the auditor?
No.
It's an incorrect conclusion made by the auditor because the sample lied to us. And it can happen. And you know it can happen because you wouldn't eat those apples that I told you to. So you instinctively know that that a sample cannot be representative of a population, right? Okay. Now you come over and remember the sampling risk is going to affect my detection risk. It's also going to affect what? That's my substantive testing. It's also going to affect my what? Control risk, because I will use sampling, assuming I'm doing a test of controls here. Of course, we're assuming that our risk of material misstatement was less than the maximum. And so we're testing the controls. And now we put the risk, sampling risk as relates to tested controls in two categories, which is risk of assessing control risk too low, risk of assessing control risk too high. Are these mistakes that are made by the auditor based on the sample? Are these mistakes that are made by the auditor based on the sample?
I'd say yes.
Yeah. I mean, when a basketball player, Stephen Curry, takes a shot and it goes too high, that's a mistake, right? It doesn't happen that often. Okay. If it goes too low, that's a mistake and he misses the shot, right? Okay. So yeah, these are mistakes that are made by the auditor based on the sample. So risk of assessing control risk too low, what happens? I pull a sample and I pull a sample of 100 time cards and I look and all the time cards are signed. So I conclude that this control has operating effectiveness based on the sample, when if I had looked at all 10,000 time cards, I would have found, 8,000 of them weren't signed. I was just unlucky. And I got a sample that was not representative of the population. So based on the sample, I assess control risk too low. Conversely, assess control risk too high, pull sample, I look at 100 time cards and I find 50 of them aren't signed. But it turns out that out of, 10,000 time cards, those were the only 50 that weren't signed. It happened that way, but I was unlucky. It can happen, right? Just like you can eat a poison apple. Okay. All right, good. So we go ahead and we have those two components of our sampling risk on our test of controls. Okay. Now you come over and they tell us that the risk of assessing control risk too high and the risk of incorrect rejection will affect the efficiency of the audit. Let's think about this. If you assess control risk too high, you say, hey, based on the sample, this control does not have operating effectiveness. What are you going to do? You pull a sample, you look at the sample, looks like the supervisors say didn't sign the time cards, so you assess control risk at the maximum. When in fact, if you had looked at all the time cards, you would have found that they did a pretty good job of having that control, having operating effectiveness. So what are you going to do as a result of the sample telling you that the control did not have operating effectiveness?
More work.
Be more specific, please.
You're going to do more substantive testing and more tests of details.
Okay, good. I'm going to change my assessment of risk material misstatement from what I had originally hoped it was going to be, less than the maximum, to what? Maximum. Mm-hmm. I'm going to want to drive down my detection risk. So I'm going to do what? And the reason I say be more specific, for the auditing exam, you can't just be saying do more work. You got to say nature. I'm going to use a more effective procedure instead of a less effective procedure.
Okay. I'm going to use more effective procedures instead of a less effective procedure, and I may do more procedures because that would be the extent. And I'm going to do more procedures closer to the balance sheet date.
Good. And extent is really what we're talking about here, because what's
Right.
going to happen, that's going to
I'm going to have a larger sample size. I'm going to, look at more stuff.
Good. Okay, good. Okay, good. And when you do that, you're doing that even though you had an effective control. So you're not being very efficient, right? Okay. Now, what happens? Risk of incorrect rejection. Well, what happens here? If I believe there's a material misstatement in the financial statements, what am I going to do? What am I going to do?
You said you said it really fast. You said if you believe there is going to be a misstatement.
There is a material misstatement in the financial
okay.
statements based on my audit sampling. Okay. When in fact, there really is not, right? Because I'm
right.
Rejecting. But if I think there is, what am I going to do?
Increase my sample size.
I'm probably going to want to increase my sample size for my substantive test to see, well, how bad is this? Because I'm going to have to propose an adjustment or something, right? And when I increase that sample size, what will I find? Oh, there really isn't a material misstatement. So in both cases, I do what? I come to the correct decision, but not in a very efficient manner, right? Okay. Now, the effectiveness of the audit is influenced by the fact that if I have the risk of incorrect acceptance or the risk of assessing control risk too low. So what happens here? I go ahead and I say, hey, control risk is at less than the maximum. So I accept a higher detection risk, but I was incorrect in that assessment of my control risk because the sample lied to me. So I now am facing that I probably won't do enough substantive testing, so I'm increasing the chance that I'm going to miss a material misstatement. Risk of incorrect acceptance is by definition audit failure. I gave the wrong opinion based on the sample, right? And so my audit is not effective. Okay. Okay, good. Now you come over, and this chart is what I want you to flashcard, because notice we went through a lot of information there and I didn't ask you for any flashcards. So what you can do is copy this page. If it's not already a flashcard in your Becker flashcards, copy this page and make a flashcard out of it. But let's just make sure we understand how this table works. Okay. So the sample indicates that the population is okay. And the recorded value is really okay. Now look, we don't know for sure ever if it's really okay, but the examiners are God and they're telling us it was okay. If they tell you that, that means we made the correct decision. Sample says it's okay, okay? And the substantive sampling procedure we use says it's okay. And it really is okay, which the examiners would have to tell us that, or God would have to tell us that, then that's the correct decision. Okay. Now, if the sample indicates that the population is okay and it's not okay, that is the risk of incorrect acceptance. Our audit is not effective. Okay. Sample indicates that the population is not okay. It's really not okay. That's a correct decision. Sample indicates that it's not okay when it is okay. Then that's the risk of incorrect rejection. Our audit is not going to be efficient. Tested controls chart works the same way down here. Okay, sample indicates it's okay. It really is okay. That's a correct decision. Sample indicates it's okay. It's not okay. That's the risk of assessing control risk too low. Sample indicates the population is not okay and it's really not okay. That's a correct decision. Sample indicates that the population is not okay when it is okay. That's the risk of assessing control risk too high. Our audit is not efficient. If we assess the control risk too low, our audit is not effective. Okay. Now, you may see some problems that look like this in your homework. And I think like the first set of questions for module 8 or 9 have these tables at the beginning, and they say a partner was trying to explain audit sampling to you and gave you these charts, right? Skip those questions. skip those questions at the beginning and get to the more common type of questions, and then come back and work those at the beginning, because I don't want you to freak out at the beginning trying to understand those set of questions. But you really need to know this chart, and you really want to flashcard this, okay? Okay, good. Now come over, and as I mentioned on this page, we would have non-sampling risk, okay, that drive up our audit risk are things, for example, we select the correct procedure. We don't recognize a misstatement in a document that we're looking at. I always call this the hangover effect. You know, you're a little tired. We're humans, we miss things, okay? Concealment due to fraud, put that down, concealment. It says concealment would also be, you know, they try to hide fraud, don't they? Okay, so that could be a factor that has nothing to do with sampling that are driving up our audit risk. Okay, okay, good. Now, as we've said, we use audit sampling for our test of, I should say, attribute sampling for our test of controls. Okay, and so attribute sampling really is a yes or no question. Did the supervisor sign the time card? Does the sales invoice have a credit approval, whatever, right? Okay, so that's what we're going to use attribute sampling for. And we have something called deviation rate, and we have something called tolerable deviation rate. Now, what I want you to put, and you don't call it this for exam purposes, but I'm just going to put the word that this is a planned deviation rate. Okay, so let's say we're sitting there and we say, well, okay, we are looking at time cards, okay, and we are thinking that the supervisor should sign the time card because the supervisor should know, you know, how many hours the employee worked. And so we look at that control, we say, that's a pretty important control. So I'm willing to tolerate, okay, I'm willing to tolerate, we'll say, we'll tolerate the person not signing the time card 3% of the time. So if I look at 100 time cards, I'm willing to accept what? 3 that aren't signed. And I'll still believe that this control has operating effectiveness. That's my tolerable rate. At this point, how many time cards have I actually looked at? Flashcard that definition, tolerable. At this point, how many time cards have I actually looked at?
0.
None, right? I've obtained an understanding. I've evaluated the design. I maybe did a walkthrough to see that it was implemented. I came early and saw the supervisor, you know, watching the staff clock in and stuff. Now, look, if I go and the supervisor's showing up, you know, late to work himself and comes in all frazzled and isn't paying attention when I do my walkthrough, then it's not implemented. I'm just going to go ahead and assess the risk control risk at the maximum and not even test this. But I did a walkthrough, looked like it was implemented. I like the design. And so I'm going ahead and test operating effectiveness. I said, okay, I'm going to look at 100 time cards and I'm willing to accept 3 times that the guy didn't sign the card. Okay. Now that is different. And it's a little annoying because they say deviation rate versus tolerable rate, and then they never compare them. Okay. But you come over, and for our purposes, I want you to put the word actual deviation rate. Okay. And the deviation rate is the auditor's estimate of the deviation rate of the entire population from which the sample was selected. And again, I'm putting quotes on that because they don't call it actual, they call it tolerable deviation rate. And then they just call it deviation rate, but that means the actual. So now I pull the 100 time cards and I find 4 that aren't signed. So if I find 4 that aren't signed, what's my deviation rate? Not a trick question. 4%?
4%, yeah.
Okay. So is the auditor happy or sad at this point?
Sad.
Sad.
The auditor is sad because the auditor said, hey, I'd be willing to select what? To tolerate 3 not signed, they cracked my tolerable rate. So now I'm going to have to do what? I'm going to have to go and do the nature, extent, timing on my substantive procedures, right? Because the control did not have operating effectiveness. Now let's say that the auditor's tolerable deviation rate had been 6%. Let's just change that up a little bit. And I pull the sample and I find 4 that aren't signed. Now what's the face of the auditor?
Happy.
Now the auditor is happy because he said, hey, I was willing to accept 6 and I only found 4. Okay, this control has operating effectiveness. I can stick with my plan to be using internal evidence instead of external evidence, larger sample sizes for smaller sample size for my testing, doing maybe some interim testing. Good. Okay. All right. So make sure you flashcard that definition of tolerable. And then let's just come over and the definition of the deviation rate, which is the actual, but they don't call it that for exam purposes, but I'm just putting that to give you a sense of where those things are coming from. Okay. Okay, good. Now come over.
Okay, I have a question.
Yeah.
So how you determine the rate, the deviation rate, the tolerable deviation rate?
Okay, I will tell you that right now, but I'm going to have you write it because I have an example coming up that will address that question. But let's just go ahead and write it right here. Okay, so to answer your question, and I want you to go ahead and I'm going to write something right here. So if my control risk, I assess it at low. Okay, and remember we said that in order to support a low assessed control risk, you need better evidence. Okay, so that's telling me that what? That's telling me, and this is not standard, guys, it's not written in standard, but I've seen literature that says, well, if you're at a low control risk, your tolerable deviation rate, which is TDR here, should be between 0 and 3%. Now, this is not written in standard, but this is some guidance I've seen in auditing literature that'll tell you if you're low, your tolerable deviation rate should be, 0 to 3%. Okay. If you are at, say, moderate, now you're saying, well, my control risk is at moderate, so I'm willing to accept a little more deviation from that because I'm not trying to support as low of a control risk. Remember, better evidence to support the lower assessed level of control risk. So now they tell me that my tolerable deviation rate might be, say, 4 to 7%. Okay. Again, it's an auditor judgment thing, but it has to do with how low you have assessed that control risk. Okay. Okay, good. Now, coming back up, what we're going to look at here is we're going to look at an example, and this is a very good example of attribute sampling. Okay. And so what we're going to do is have a test that we're going to be doing, and we want to see if a sales invoice has the appropriate credit approval. So we're looking at a sales invoice. And we're looking to see if the credit department first checked the person's credit and approved them. Okay, so we're looking for a little box approved, or we're looking to see maybe there's some in there that weren't approved, right? It's kind of hard to draw a picture of one that's not approved, but we're really looking to see if there's any that were not approved. Okay, all right, good. Now, why does the auditor care? Why do I care if a sales invoice, a credit sale was approved, did credit approval?
Prevent fraud?
Yeah. Fraudulent revenue recognition.
Huh?
Potential for fraud for revenue recognition.
Why would there be fraud? Why would that be fraud?
Well, we want to inflate our revenue so we can get paid a higher bonus.
Okay.
I'm
No.
gonna say it's basically, it gives you some assurance that they're watching credit quality, because the whole point of credit approval ties into whether or not the accounts receivable are going to be collectible and how big your valuation might need to be.
Stop. You just called out an assertion. We do audit procedures for assertions, don't we?
Yes.
We do audit procedures to test assertions. And the assertion that Kathy mentioned there is valuation. And we look for control that'll prevent or detect the what? Misstatement in the valuation of our accounts receivable, right? Okay,
right.
so this is a valuation control, or control over the valuation assertion for our accounts receivable. Good. And so we line up our controls and we line up our audit procedures with the assertion, don't we? Okay, so this is going to help us with the valuation assertion. Okay, good. Now we take a look and they tell us that when we define the population, okay, and they tell us that in this example, the population would be all sales orders used during the year. You got to have all of them available for testing. And if the tests are performed at an interim date, don't forget you have to do some sort of roll forward there. So you might take a smaller sample for the, you know, back end of the year or whatever, but always remember you have to roll forward. Okay, good. So go ahead and flashcard that. The testing's done in the interim. You always have to remember to do some sort of roll forward. Now, each sales order is the sampling unit. Okay, and let's take a look and see what we're looking for. Okay, and we're looking for deviations, and deviation is a missing credit approval. A missing sales order is a deviation. If you can't find a document to perform your test, then you assume there's a deviation. You know, they can't say, hey, Joe, we're missing sales order 101. Was that one approved? Oh, yeah, it was approved. No, you have to see it, right? You have to be able to inspect it to know that it was actually, you know, actually had the credit approval. Okay. Now, determine sample size, okay? And they tell us that the risk of assessing control risk too low, and they say that there is what? There is a, I know it says here somewhere, there's an inverse relationship to sample size, okay? So the lower you're trying to get that risk of assessing control risk too low, the larger the sample size. Okay, let's think about this for a second. Let's go back to the apples for a second. Okay, so I tested 10. You said, no, sorry, John, you know, I'm not going to eat those because there might be poison. So I test 20. All come back knowing poison. You want to try an apple? 30. Okay, 40. Okay, I test 90 apples. They all came back poison. Come on, eat one. And you're going to say, no sample size is big enough when the risk is that great, right? But you will say, test all the apples in that case, right? And so the larger the sample, the more you can trust that sample. And thus, you know, we want to lower the risk, we need a larger sample size, inverse relationship. Tolerable deviation rate also has what? An inverse relationship to sample size. So what happens? As we've said, we need more better evidence. So if my tolerable deviation rate is what? Between 0 and 3, it's larger. My sample size is going to be what? Is going to be larger because I'm sitting there and I'm saying, this is an important control. I've assessed control risk at low. This is really important. So I want to what? Really check it out because I'm not going to really tolerate much deviation from that, right? Okay. Now, if you're willing to accept a larger tolerable deviation rate, that's equivalent to saying, okay, it's not that important of a control because sometimes if they don't do it, it's okay. So if you're saying that that control is not as critical, you're more of a tolerable deviation rate, then you can have what? Then you can have a smaller sample. What if I assess my control risk at the maximum? So I'm saying, hey, my tolerable deviation rate, man, I don't care. It can be 10% on this. I don't care if they apply that control. That's not a very effective control. I've assessed control risk at the maximum. I don't like the design or I don't like the implementation. What's my sample size for my control testing then? If I assess control risk in the maximum. If I assess control risk at the maximum, what's my sample size for my control testing?
0.
0. I don't test it. That's a really small sample size, isn't it? 0. Okay, so what? As the control risk goes up, sample size comes down. As the control risk comes up, your toleration, is that a word, of the control not having operating effectiveness goes up, right? So it's an inverse relationship, okay? Expected deviation rate, it is a direct relationship, okay? If I have a client that always messes up a control, and then I walk in one day and they say, hey, we fixed the problem. We fixed the problem. What am I going to do? I'm going to pull a big sample to see if they really got it now, right? And I might do that for a couple of years. But after a couple of years, I see, okay, they understand the importance of this control and they are using it properly. It has operating effectiveness. I'm actually relying on evidence from previous audits to say what? I can now trust a smaller sample size for my control testing. Okay. And finally, population is for larger populations. Population does not really affect sample size. Okay. Okay, good. Flashcard these. I promise you, you'll get questions that are going to expect your understanding as to how these different factors affect sample size. Okay. Okay, good. Now we come over. And this is where this example gets really good because they literally have pulled some tables from the AICPA's sampling audit guide that you would use in determining sample. Now, these days, they probably have software too that does this, but the software are drawing information from the way this table works, okay? So they tell us that assume we're testing those sales order for credit approval, and we're willing to accept a 5% risk of assessing control risk too low. And we have an expected deviation rate of 1%, tolerable deviation rate of 6%, and they want us to determine the sample size from the table that follows. And guys, I recommend that you not mark up the table the way I'm going to, because you might find this table useful to kind of play with a little bit, but if you mark it up, it kind of takes some of the fun out of it, okay? So I'm going to mark it up though. Let's take a look. And we see that we're on the 5% risk of assessing control risk too low table, okay? They do it based on the tables, based on the assessment. This means that we are at the 95% confidence level. That means the auditor will be 95% confident in the determinations that they make from the use of this table. That means that there's what? A 5% chance that we could make the mistake of assessing control risk too low. If we want what? If we want only 1% chance of assessing control risk too low, we'd have to go to the 99% confidence level table, and it's a whole nother table, right? Is there any 0% risk of assessing control risk too low? No, because we always say, hey, the sample could be, lying to us here, right? Okay, so we use those parameters up there. We know that we're on the right table. And be careful, guys. Make sure you understand that 95% confidence level thing, because the exam may tell you that the auditor has a 5% risk of assessing control risk too low, and then give you a 95% confidence level table and a 99% confidence level table, and not call it the 5% risk of assessing control risk too low table and expect you to gravitate to the right table. Okay. Okay, good. So we look at this and they said what? Expected deviation rate is 1%. Tolerable deviation rate, and I don't think you should mark up the table, but you know, because you can practice with it. They tell me is 6%. Okay, so my sample size is what, 78. Okay, now they say, would the sample size increase or decrease if the expected deviation rate went to 0%? Now they told us the sample would decrease, but let's see how that works. You go up here now to 0%, still 6% tolerable deviation rate. Sure enough, it would decrease, and you can even write in, it would decrease to what? To 49? Because we have some previous experience or something with this client in which we think they do a pretty good job of having operating effectiveness on this control. Okay. Okay, good. Then they say, would the sample size increase or decrease if the tolerable deviation rate increased to 7%? And they tell us the sample would decrease, but let's go ahead and just play with it. We were over here at 78. We come over to the 7% tolerable deviation rate. Yep, sure enough, it decreased, and you can even put in there, it would decrease to what? To 66, because we don't need as big a sample if we're telling you we're willing to tolerate, you know, non-compliance with this control technique. And if we really don't care about this control, we don't even care if they implement it, we won't test the control at all. Okay, and then you come over, and with the sample size increase or decrease, if the risk of assessing control risk increased to 10%, if I'm willing to take a bigger chance that I'll make the mistake of assessing control risk too low, I can take a smaller sample, and I would have to go to what? Go to different table. I can't use this table because this is the 95% table. Are you saying something?
Yeah, I have a question. It says the sample size, in the other ones, it talks about expected deviation rate, tolerable deviation rate, but this one, it talks about risk of assessing the control risk too low. I'm a little confused about terminology. I'm getting confused about
risk
what that
of assessing
means.
control risk too low is analogous to risk of eating a poison apple.
So is that the tolerable rate?
No.
Is that the expected
risk of
deviation
control
rate?
risk too low. Is assessing control risk too, is eating a poison apple an accident, a mistake?
Yeah.
Okay, is assessing control risk too low a mistake?
Yes.
Okay, if you want to lower the risk that you'll make the mistake of eating a poison apple, how many are you going to ask me to sample if there was 100 apples in the barrel?
All 100?
All 100. In fact, no sample size is big enough to satisfy you, right? So
Right.
if I'm trying to avoid the mistake of assessing control risk too low, I need to what? I need to get that chance down as low as I can, right? Thus, I need larger sample sizes, right? If I went from the risk of assessing control risk too low from 5% to 10%, I just increased the chance that I'm going to make a mistake, right?
Mm-hmm.
So I don't need as big a sample size.
Okay. So does the term risk of assessing control risk too low correlate to tolerable rate? Is that the same term?
No.
No. So
no, risk of assessing control risk too low is making a wrong decision about the control. Tolerable deviation rate says, how much deviation am I willing to accept from this control? And again, what I was trying to say up here with this little picture I had you draw is it really relates to how low you're trying to get your control risk. The risk of assessing control risk too low is a swing and a miss. You make completely the wrong decision.
okay.
This is telling me how much I will tolerable deviation rate is telling me how much I will tolerate of non-conformance with this control technique and still be satisfied that I'm getting the coverage from the control that I need to make my decisions about my substantive testing.
Okay, is there a chart for risk of assessing control risk or not?
What do you mean a chart? How do I assess control risk? How do I assess control risk?
I think you do a test of controls and figure out if you can rely on them.
How do I assess control risk?
I think I try to understand the, get an understanding of the client and do some tests of controls.
Well, that's not how I assess control risk, not by testing them. I assess control risk by obtaining an understanding of the controls sufficient to evaluate the design of the controls and determine if they were implemented. And based on that understanding, I make an assessment of control risk. And if I assess it at less than the maximum, I now have to do what? I have to test the operating effectiveness. How do I test the operating effectiveness? I will pull a sample of transactions and see that the control has operating effectiveness, right?
Mm-hmm.
Okay. All this is telling me now is how big that sample should be. And if I want to lower the chance that I will completely F this up and make the wrong decision based on the sample lying to me, I need to lower the risk of assessing control risk too low by making the wrong conclusion based on the sample. Tolerable deviation rate is relating to whatever I assessed it at, because if I assess the control risk at, say, low, I need better evidence to show me that that control is working properly. So I'm probably going to want more reperformance, more observation of that control, that higher levels of the hierarchy of the evidence that we talked about for our controls, and larger sample sizes, because I'm sitting there and I said, control risk is at low. So I'm not going to do as much substantive testing, but I need to make sure that this control is actually working. So I'm going to do what? I'm going to pull a larger sample size for that. And I need to protect my ass from the possibility that the damn sample will lie to me. And so I do that by pulling larger samples. And that's why when you get to, hey, we're willing to accept a 10% chance that you'll make the mistake, then you can take some smaller samples. In fact, if you're feeling, what did Clint Eastwood say? Well, punk, do you feel lucky, punk? Well, do you? Hey, if I feel lucky, go ahead. Don't take any sample. Don't do any control testing at all. And set your, detection risk at a higher level. And, what you'll be doing is, laying out on the street someday.
Okay, I think I was just thrown by the fact that it's increased to 10%. And I think I was looking, okay.
Okay, there's a thing called confidence level, okay? And you take 100 minus the chance that you'll be wrong. And that means you are 95% confident in your decision, in your conclusion that you're drawing from the sample. So you read a study, and the study will say at the 95% confidence level, we have found that 9 out of 10 kids that don't have a good lunch will throw up their breakfast, whatever. I don't know, whatever it is they say, right? Okay, so that is going to be the confidence level. Okay, now if I'm sitting there and I only want a 1% chance that I'm giving the wrong conclusion, then I'm trying to draw 1% there. Okay, 1% that I'll draw the wrong conclusion. Then I'm at the what?
99%.
Then I'm at the 99% confidence level. I'm much more confident in the conclusions I make based on that sample, right? It'll never be 0. Okay, so it really depends on what you're doing. That's why I'm saying, if you're going to go blind because the sample, gives you the wrong conclusion, you're probably going to want to take as big a sample as possible, right? You want to be really, really certain. If, you're going to die, the poison is not the Sleeping Beauty poison. It's the one that, breaks your back and all that before you die. You're going to say, No way, I'm not going through that. So I'm going to sit there and I'm going to pull a much larger sample size.
Thank you. I think I was getting those concepts confused. So thank you.
Yeah. Okay. Okay, good. Now you come over and we take a look and we select the sample, and it has to be random. And I think I already asked you to flashcard that, but you should at least understand this notion of block sampling, okay? And block sampling is not acceptable for audit purposes. Block sampling is used like by census, when they want to go through and they'll do their sampling by blocks, and it's okay if that's that kind of a sample, but for audit sampling, it is not acceptable. Okay, all right, good. Now we evaluate the sample results, and we're going to go to this table on the next page, table 2, and we're going to find something called the upper deviation rate, okay? And we want to be sure that if we pulled the sample from, say, the 5% risk of assessing control risk too low, the 95% confidence level, we evaluate the sample results on a 5% table. We'll locate the sample size and the number of deviation, and that will yield to us something called the upper deviation rate, okay? And they tell us that the upper deviation rate is a cushion to protect against undetected deviations. And they tell us that it is the sum of the deviation rate plus the allowance for sampling risk, okay? Now, I want you to flashcard that, and then I'm going to come back, and after we look at the examples, I'm actually going to plug the numbers from the example into this formula, but you want to flashcard that, okay? Okay, good. So let's come over and let's just look at this example right here. And guys, they kind of flipped on us a little bit here. They say the sample size is 100 sales orders. You know, when we looked at the table, we found that it was 78. Okay, but they're kind of throwing that out now and saying that we have 100 sales orders that we're looking at. So, Andrew, if we look at 100 sales orders and we find one deviation, what is our deviation rate? Andrew?
Was that 4.7? Or is it 1%?
1%. We had what?
Okay.
We had one deviation, and we had what? We looked at 100 sales orders. So our deviation rate is 1%.
That makes sense.
Okay. Okay, good. So we have 1%. And again, I know they said earlier that the sample size was 78, but they've changed that now. Now we look at the table and we say, hey, determine from the table the upper deviation rate. And again, I don't recommend that you not write on the table, but we're on the right table. It's the 5% table. Sample size is what? Is 100, and we found one deviation. This is telling us the upper deviation rate is 4.7%. So what are they saying to us here? They're saying, hey, be careful. It's a sample, and the sample could be wrong. And so we're going to give ourselves a cushion as to how high this deviation could actually go. Okay. Now, this is what they call precision. Okay. During elections, you hear this all the time, whether you realize it or not. They say, hey, we're at the 90% confidence level, plus or minus 3%. They're telling you what variations around what the numbers could be, and they give you both sides of the variation, plus or minus in their precision. As auditors, we don't care if it goes lower. We want to know how high it can be, because if it goes too high, we're going to what? We're not going to be able to rely on that control. So they only look at the upper end of precision here, and they're telling you that it could go as high as 4.7%. Now they say, what's the allowance for sampling risk? Well, we have given ourselves a cushion, haven't we? 4.7% minus the what? The 1% means we've given ourselves a cushion of 3.7% here, haven't we? Even though we found one deviation, we're saying could be as high as 4.7%. So the auditor is what? Is 95% sure that the deviation rate does not exceed what? 4.7%. We're still saying, Kathy, we might have effed this whole thing up. There's a 5% chance that this is some weird population that just kicked us in the butt. What are you gonna do? Life is hard. We don't have time to look at every single transaction. We're going to have to rely on a sample. We're going to have to accept some sampling risk. We're going to have to accept some audit risk. That's why we have malpractice insurance. We share the risk.
So then there are charts for assessing control risk too low, correct? There are charts about this, like the ICPA puts them out or something like that.
What do you mean? There are charts for set. I don't know what that means.
Oh, because I'm looking at a chart that says 5% of assessing control risk too low.
Oh, this is telling me, yeah, this is telling me once I have, if I sat here and I was at a 1% risk of assessing control risk too low, there'd be a different chart.
Okay, yeah, I think that's, so there are charts about this. I guess
there's ways to evaluate the sample. Sorry, guys, I just want to see if I know I have that guide up here somewhere. There's a guide that they come out with that has all that, but I'll be damned if I'm going to be able to find it right now. Yeah, no, I can't find it, but somewhere in this mess that looks so organized when you see it behind me here that I can't find anything on that on the thing. But anyway, there's somewhere on that bookshelf, there's a book that has these tables.
Okay.
Yeah. So yeah, that's what you're talking about. Yeah, they give you these to help you evaluate the samples. Okay, they don't give them to you, you got to buy them, but yeah. Okay. Okay, good. So now I want to come back, now that we understand that example, and let's just look over here. And sample deviation rate in our little example is 1%. We add the allowance for sampling risk, which we determined to be 3.7%, and our upper deviation rate was what? 4.7. Okay. Or you could do this the other way, which is what? Upper deviation rate minus what? Minus the sample
Deviation risk.
Deviation rate. Okay. Equals what? Equals the allowance for sampling risk. In case we have a question that asked us the allowance for sampling risk, the way that exercise did. Okay, so you can flashcard that too. Okay, all right, good. Now, let's go ahead and let's take a look, and we form a conclusion, and we say that if the upper deviation rate is less than or equal to the auditor's tolerable deviation rate, which we would have set during our planning, the auditor may rely on the control. Okay, you can flashcard that. If the upper deviation rate exceeds the tolerable rate, the auditor may look for another control that compensates for the control that just failed the test. Or probably more likely, modify the nature, extent, and timing of my substantive test. Now I'm going to move to what? Using more effective procedure like external evidence, larger sample size for my substantive testing, do some year-end testing. Okay. Now, you come over and flashcard that. But let's practice now with those numbers that we got from our little example. And they tell us if the tolerable deviation rate is 3%, would the auditor rely on the control? Answer is what? Answer is no. The table told me the deviation rate could be as high as 4.7%. Once we included that allowance for sampling risk, you were only willing to tolerate 3%, so the control failed. If the tolerable rate was 6%, now the auditor is saying, yeah, I can rely on that control because I was willing to accept 6 and the table told me it could be as high as 4.7, right? Okay. And then of course, remember, you always have to document the procedure. Question. Okay. I will come back to discovery sampling probably next time because we're about out of time, but I want to go through these questions together, guys. So we're going to go a little bit over, maybe about 1 minute over. I want to go through these questions because I want you to practice with this right now while we're crystallizing our understanding. Okay, so let's go ahead and let's just look at this first question. Okay, guys, I'm going to go ahead and end the poll. I think most of us that are going ashore have gone ashore. So let's go ahead and yeah, good. Good results on this. We use attribute testing for what? Attribute sampling, I should say, for our control testing. And the only one here that is a control type test is what? Inspecting time cards for supervisor signature. In fact, we use that quite a bit in our discussion. B, all the rest of these are what? All the rest of these are substantive procedures, aren't they?
Yep.
Okay. Okay, good. Let's take a look at question 2. Okay, guys, go ahead and make your selection because we're starting to go over time here, and I definitely want to look at this question and question 4 with you. I'll let you look at question 3 on your own since we're running out of time. But okay, looking at the results here, this is kind of a hard question, and so I think it's good that 73% of us got it correct. But let's just take a look at this one, okay? And as a result of test of controls, the correct answer here is D. Okay, as a result of tested controls, the auditor assessed control risk too low and decreased substantive testing. This assessment occurred because the true deviation rate in the population was more than the deviation rate in the auditor's sample. Now, is assessing control risk too low a mistake? Is eating a poison apple a mistake? Okay, so we could reword this question, say, as a result of tested controls, an auditor did what? Assess the chance of a poison apple too low. In other words, what happened? This is a barrel. These are apples. There's 5 apples in the barrel, okay? The auditor did what? Here, let's have the auditor come over. Okay, that's the auditor comes over. The auditor did what? The auditor tested 4 of the apples and they weren't poisoned. So the deviation rate was what? 0 divided by 4. The deviation rate was 0%, wasn't it? Right? Based on the sample. Mm-hmm. The auditor did what? The auditor ate the 5th apple, okay, and died. Dropped the apple, hat fell off. I mean, it's a whole bad scene here, okay? The auditor died because what? Because the true deviation rate in the sample, the true deviation rate, I should say, in the population was more than the deviation rate in the sample. The sample said what? The sample said 20%. The sample said 0% when the true deviation rate was 20%, wasn't it? 1 out of 5. Okay, so what happened? This assessment occurred because the true deviation rate, they made the mistake because the true deviation rate in the population was what? More than the deviation rate in the sample, right? And if that happens, you're going to assess control risk too low. You're going to make a wrong decision, aren't you? Question? Okay, let's do this last one, number 4. I'll let you do that other one on your own, but let's do this last one, number 4, together, okay, since we're running out of time, or we're out of time. So let's just look at number 4. An auditor uses statistical sampling for attributes and testing controls should reduce the planned reliance on the prescribed control. When should you reduce the reliance on a control? When what happens? When would you not rely on a control?
When it's not working.
How do you know it's not working?
You find failures when you do your sampling for attributes. You find a failure rate that's higher than your tolerable failure rate.
Oh, in other words, very good. You're saying that I determined that my upper deviation rate is more than my tolerable rate. Is that what you're saying to me?
Something like that.
Well,
I think huh?
That's what you just said. You said that the deviation rate is more than my tolerable rate, but we call that the upper deviation rate. My tolerable rate is 3%. And my upper deviation rate is 4.7%. We all agreed that the auditor would what? Would not rely on the control, right?
Mm-hmm.
Didn't we say that?
Yeah.
Okay. How do you calculate upper deviation rate?
That's the sample deviation rate plus the allowance for sampling risk.
Good. The sample deviation rate of, say, what DR is deviation rate. The sample deviation rate of 1% plus the allowance for sampling risk of 3.7% is how we got an upper deviation rate of 4.7%, and that was more than the tolerable deviation rate.
Yeah.
So I didn't rely on the sample. I reduced, I mean, on the control. I reduced my reliance on the control, which is what this question is saying would happen. And isn't that true that the sample deviation rate, the auditor would reduce the plan reliance on the control when the sample deviation rate of 1% plus the allowance for sampling risk of what? 3.7% exceeds the tolerable rate of 3%? Isn't that what that choice D, the correct answer here, is telling you?
Yeah.
Yeah. I'm sorry, the terminology, it's still not in my mind real good, so.
Well, I don't know what that statement means.
Oh, I have to
You mean
think
the
about
fact
the
that I said
terms.
you said that even though you didn't say it exactly the way I wanted you to? But you still have the concept.
Conceptually, I sort of understand it. I get my terminology mixed up and I call the different things the wrong thing.
Flashcard. Flashcard is a solution to that. Flashcard is the weapon that gets you to be very comfortable. That's why I had you kind of flashcard all those things as we went along. Okay. All right, guys, we're going to call it a, this is somewhat of a success. We didn't finish. Yeah, I think we're done enough with module 8 that you should be able to go ahead and go through and do the module 8 up through module 8 of chapter 3. We'll come back. We'll finish up chapter 3 next time and start chapter 4. Okay. Question? Okay, guys, keep working hard. We will see you soon.
Thank you.
All right.
Thank you.
All right.
Have a good night.
Good night.